bit of data on the US. The last time the question was on what happens with Japan adopting quantitative easing, issuing a lot of money. Now, what will happen is yet to be seen, so we cannot have data on that. But what we can do is to look at another country, the US here, for which we do have data where the central bank has increased money. I did talk about it already, but here is data to support what I was talking about last time. So this chart is about monetary base or high-powered money, which is the money that the central bank the currency is the public and the reserves that the commercial banks hold with the central bank. So C plus R is what we are talking about here. This is high-powered money or waste money. You can use the terms in reserves by commercial banks with the central bank. This chart shows the data for base money for the US from about 1985 onwards, and what you can see is that there is a smooth, except a bit of change here. They know that cost intensity, but by and large, what you can see is a smooth rise in base money. Why does it increase? Well, there is economic growth. You have national increasing, and therefore the demand for base money increasing. You also have some inflation, so that inflation is facilitated by an increase in money. So there could also be increased demand for this money. So for whatever reason, but these are stable increases that happen gradually from year to year. And that's what you see from around 1985 till about the crisis period, which is 2007-2008, thereabout that you have. And then there is a sudden jump in the amount of base money issued by the Fed, the Federal Reserve, which is the central bank for the US.
So there are three, QE1, QE2 and QE3, I guess.
Yes, various ones, and you can see the huge jump there.
What about the broad money? That also?
I'm coming. This is M2, money stock. So here you have what concerns the general public, which is so remember, this is currency held by the public, this is reserve held by the commercial banks. But if you're concerned with the public, then you want to know the bank deposits held by the public. So that gets us to this definition: currency held by the public and bank deposits held by the public. These could be the CASA, current account, savings account, whatever form they take in different countries. And if you look at the data for this, this is not as smooth as the previous one is, but it doesn't have the kind of jump that you saw in base money in the previous chart. Relative to that, you could describe this as a smooth, stable graph where it is increasing, and except for a bit of change in the slope here, and if you were to ignore this part and just consider a trend line, then you can look at this as pretty smooth in the context of the massive changes that have occurred in the last 4 or 5 years in the US monetary climate. So this is what you were asking. So this is not changed much. from it has not changed much. So this is the reserve balance with Federal Reserve. So our first chart showed this, the second chart showed this, the third chart is showing R, this part. So what it means is that the amount of currency held by the public has not changed. Much, I mean. The major change, almost all of it is in R, which is the reserves held by the commercial banks, and this chart is pretty similar to the third chart is pretty similar to the first chart, except that the levels are a bit different due to the traditional component C. So it is the reserves of commercial banks which have jumped up tremendously.
Which is banks earlier had virtually no reserves, huh? Till about 2009.
Exactly. No, on this chart with this scale, it seems zero.
No, yes, and
but
still, as a percentage also very
right,
small.
These are very small. These are the reserves that commercial banks hold. The cash that you have in the ATMs and the cash that you have in the back branches, somebody wants to withdraw. Barring that, you don't need to hold much cash. And some cash with the Fed for checks clearing across banks. So those would be the cash balances of commercial banks with the central bank, which would be small. So on this larger chart, they seem to be zero, but there is some amount there. But of course, it is the excess reserve. Excess meaning over and above what you need for the ATMs and for checks clearing and for withdrawing from the bank. It is a huge jump that is happened.
And that's because of the risks and the low interest rates, huh? Possibly reasons could be the, would you like anyway explaining it?
Yeah, so the reason is, so what is happening is that the government is buying, so is the Fed. And it's a bit blurred as to what the government buys and what the central bank buys, but for our purposes we could merge these together and call this the public authority. They find, let's say, mortgage-backed securities. Other financial assets. Remember, in the financial crisis, a whole lot of assets lost value. The market price was very low. So the public authorities intervened to provide support to these prices. And how do you do that? They bought them in huge quantities. So when you buy these huge quantities, then you have to pay for them. And what you are doing is that you are crediting the accounts of the commercial banks. That is taking the form of the increase in reserves held by commercial banks with the central bank. So what is important to note, and that is what I was talking about last time, this is part of the financial system. In one sense it's very obvious, but the implication of that is strong, which is that this increase in money, if this huge increase in money, has nothing to do with inflation. Because it is not being used as money which is chasing goods. So if you think of the quantitative relationship between money and prices. Then one thing, as you like this standard simple textbook, the way you can put it is that you have inflation when there is too much money chasing too few goods. So excess increase in money would be chasing goods, and then you have inflation. But how come inflation has not been there when the central bank is increasing money? Because it is part of the financial system and rather than part of the monetary system. It's not money as a medium of exchange. It's not money which is chasing goods. In a sense, it is money which is chasing financial assets. So those financial asset prices have gone up, but they've gone up from where they would have been if the public authority had not intervened. So it is there that the price increase is there, but not in the prices of goods and services more generally in the economy. So this has arrested asset price deflation, and it has not caused general price inflation in the economy. So there are two different things: the general inflation in the economy and the asset price inflation in the economy. So, for example, in India, what is happening in real estate in parts of India is asset price inflation. In the stock market in the last 1 year, where it has gone up by 20-25%, that in asset price inflation compared to the base level that it was at 1 year ago. Of course, in India, we also have general price inflation, but that is relatively lower. If you take 8 to 10%, which is much lower compared to the asset price inflation. So, when one thinks of money, one has to think in terms of asset price inflation and general inflation. So, here it is not general inflation, it is asset price. It's not asset price inflation, but it is arresting asset price deflation.
But in a way, also it can be thought of as there are, since the financial crisis, now the assets have lost its value. They become rather non-credible, if I could use that word. So effectively, the credible assets are very few. So the supply is constrained and demand, because of the money supply, they are going up like anything. So effectively, unless you bring in some kind of a credible asset in the market, the asset price inflation will be very difficult to control, and which will have further implications for the real sector.
There can be two things. One, and another way to rephrase the question is, why did the asset prices fall? Now, it could be that these assets are bad. In some cases, they are. Many homeowners are not able to repay their loans. So, the mortgage-backed securities, these assets have lost value. So, that's a change in the fundamental value of the assets. So, these are not credible anymore. And that is, the government intervention is a bailout there. The other part is that you had high leverage before that. Leverage would be familiar in a classroom like this, but let me say it quickly. If you are investing in risky assets, you could be investing in them with your own money, or you could be investing in risky assets with borrowed money from elsewhere. Now, where you have considerable borrowing to back your purchase of risky assets, then you are highly leveraged. The returns can be higher if the asset prices go up. The losses also can be higher than they would have been if prices go down. So, because of the high leverage, the prices were high, and once the financial crisis hit, then there was deleveraging. People had to repay their loans. Now, if you have to repay your loan to a bank or to some financier, now regardless of the fundamental value, you would need to participate in what are called fire sale, quick sales in the market, because you have to pay up, even though you know that this is not the best time to sell, but there is nothing else that you can do. In the sense of any support to the market prices coming from somewhere, these prices would crash heavily in no time, because there is nobody to support, and it is in that context that the market, the government stepped in to reduce the sharp fall in the asset prices. So, are these assets not credible? Well, if you look at the fundamental value, they are credible, but it is due to the deleveraging process in the short period of time that the prices can come down. In this case, it is not a bailout, it is intervention by the government to correct a market failure. The market fails to have stable asset prices. This is the data on money multiplier. I referred to this last time. So let me write this here. M is equal to, there is a relationship between these two. The money in the economy is a multiple of this. Now, in normal times, money multiplier is stable if not fixed. And so you have a rather predictable, smooth relationship between money in the economy with the public and the money issued by the central bank. But what you see here is that in a very short period of time, the money multiplier has come down sharply. So that also reconciles the previous chart, which showed that this was increasing too much and this was hardly increasing. So if you have to reconcile these two charts, then you have to say something about the value of M. And what you see here is that the money multiplier sharply reduced. To recall what we had said earlier, this is the currency deposit ratio and small r is the reserve deposit ratio. And what happened was that at a time when 8 was being increased massively by the central bank, the reserve deposit ratio was also going up. So you have something going up in the numerator and something going up in the denominator, with the result that M doesn't change much.
This is about M1 money multiplier, but what about M2 money multiplier?
The stories are similar.
Because M1 is narrow money, whereas M2 is broad money.
Yes.
That the difference could be...
Right, so it depends on how much of these are being included between M1 and M2. When you go from M1 to M2...
Time deposit is the basically difference.
Yes, more and more of deposit or deposit-like instruments are being included. But the story is similar.
But in India, the curves are exactly opposite for the M1 versus M2 or M3. The two move in opposite directions.
No, this moment. I'm not talking about this pattern. Now,
You're talking...
I'm just focusing on this part, this sharp fall in a short period of time. So, that is the concept. I think what you have in mind is more the long-term behavior of this graph for M1 and a similar graph for M2, a picture for the US for M1, M2 and a picture for India for M1, M2. This shows bank credit, and again you can see bank credit moves rather smoothly. It increases from year to year. But here you have a big change. Now, what some people have emphasized is that the credit has picked up, and by that what they mean is that the slope of this part is pretty close to the slope of this part. So the growth rate of bank credit now is similar to the growth rate of bank credit that it used to be before 2007. Now all that is fine. However, comparing the growth rate of bank credit now with the bank growth rate of credit before 2007 is missing the intended story, which is that if you were to move along this path now, then you are well below the path it would have taken otherwise in the essence of the financial crisis. And that decrease in bank credit is substantial, and this fall in bank credit hurts the medium enterprises, small enterprises, medium enterprises. The larger corporations manage to issue commercial paper for their short-term needs. Of course, in the financial crisis, even the commercial paper market had been hit, and hit very, very badly. But the loss to them would be short-lived, but for other enterprises it matters a lot more. So what I want to say here is that this story, while it is not as drastic as it is for base money trade, it is also not as smooth as money. So money has been the smoothest, credit less smooth, and of course base money has showed a very different pattern altogether. So all this is in the context of what happens when the central bank increases money. Now this is what the US has done over the last 4 or 5 years. What we are seeing now is Japan, and particularly after this change in government, the Japanese wanting to do a similar thing in Japan as the Americans have done. The question was on Japan, but since the Japanese data is not there, but the policy just got started, this is why I was doing a background with this. Now, to the extent that the story in Japan in the next few years is going to be similar to the story that has unfolded in the US in the last few years, then you would see a similar pattern in the graph for Japan in the next 3-4 years. So that was to come to the specific answer to the question as to what would happen in Japan with all the quantitative easing. But I do have some data on Japan, and I'll show you that. Inflation rate. So far we were talking about the US. Now we are moving on to Japan, though not on similar variables. Inflation rate. Look at some parts here, it's negative. That is the deflation part. Japan stands out in the world in this regard. Of course, in the past, there have also been high inflation rates in the 70s. This is the oil crisis which hit the world economy as a whole, including Japan. But after that, it has been very low inflation, zero inflation, and even deflation for significant number of years. Price deflation in Japan coming to an end. This is another chart. This is from 97 onwards. That was a more long-term chart there. And what you see here is the consumer price index. So this is the level of the index. It's not the inflation rate or the deflation rate. which would be the percentage change in the price level. This is the level itself, and what you see is this falling. But here you have, if you like, the stability in the price level in Japan. Now, this is the context in which there's a change of policy. What is the Japanese Central Bank saying, or rather the Japanese government, Ministry of Finance saying? It says that this blue line, blue or purple or whatever, this is the actual inflation story. So you have inflation rate which is positive for some years, but it is low, and you have negative for these years. Of course, it is not some 10% or 20% deflation rate, which was the kind of story that one had seen in the US during depression. But all the same, in the context of the modern times, this really stands out. And many economists argue that deflation is not good for the economy. There is not a unanimous view on that. There is a debate, but let's keep that aside. The inflation here, as of now, the Japanese authority are viewing deflation negatively, and they want to get rid of it. And you have here, this is the Bank of Japan 1% target. So, by the way, you have the idea of targeting. Central banks aim to target a certain inflation rate, which is typically 2%. In case of Japan, it's 1%. But what you see is that the actual inflation rate is well below that 1%. It's even negative for several years. But now with the new government, what they want to do is to target a 2% inflation. So with that high inflation rate, of course, it would require change in monetary policy. More specifically, it would require a higher percentage increase in not only base money but also general monetary policy. Now, with the announcement that the government has made, the market has taken that intention seriously, with the result that the yen has depreciated. We remember that inflation and the depreciation of the currency go together. So if the inflation rate picks up in Japan, then it is likely to be accompanied by depreciation. Now, the general price level in the US economy is going to take some time. The prices in the economy tend to be sluggish, which we know in textbooks as price rigidity or even as price wage rigidity. But the idea of that is that these are sluggish and take time to change. The exchange rates are more flexible, and in efficient markets where the traders look ahead and look at the intentions of what the government intends to do, then they factor that into their pricing, and the yen has already weakened, which was also another intention of the government, to weaken the yen and use that to encourage exports from Japan. Many of us know Japan as a trade surplus country, exporting a lot more than import, which is what has been happening for several decades. But of late things were changing there. So it was also felt that there is a need to change the trade policy. this shows the Japanese government bond yield. Very low rates of interest. The US and the European low rates of interest are more recent. They are familiar to us now from their quantitative easing policy. But Japan has had, this is only recent data. I wish I had earlier data, but very low rates of interest has been around in Japan for a long period of time. And but remember that there's also deflation in the Japanese economy. So the interest rate after adjusting for that deflation is not as low as it would seem. It is low, but one just needs to adjust for the deflation in the Japanese economy.
But the low rate of interest, are they not reflecting that the government bonds are the safest bet and everybody is trying to just buy them up, even if the interest is low? I mean, the asset price inflation which we talked about.
Yeah.
Here you have a kind of a situation that everybody lapping up those.
That if it is a freely determined interest rate, then yes, you are right. But the market may not be completely free, and the market not being free can take various forms. Now, I know India better, so let me explain this with the Indian example. The interest rate or the yield, since we talk about the yield on government India bonds is 8-9%, thereabouts. Now, you take the inflation rate to be if you take the inflation rate to be 9% in India and take the yield to be 9% on government bonds, just broad figures I'm giving, I'm not giving exact data here. It's a bit distracting. Can you please